Module 7, Practical Investing for Normal People. Simple, realistic steps to start investing wisely. Module Outcome. By the end of this module, students will understand the difference between ETFs and individual stocks. Learn the logic of investing in the S&P 500, including relevance for South African investors. Be able to create a monthly investing plan. Know Buffett's advice for most individual investors. Identify common beginner mistakes to avoid. Core transformation. Students live with a simple, realistic investing plan they can implement immediately. Lesson 1: ETFs versus individual stocks, Buffett-style view. Key insight. Individual stocks, owning a slice of a single company. Or potentially higher rewards. Or higher risk if you don't understand the business. ETFs, exchange-traded funds, a basket of many companies. Or instant diversification. Or lower risk. Or lower maintenance. Buffett recommends. Most people are better off investing in low-cost S&P 500 index funds rather than trying to pick winners. Reflection exercise. How comfortable are you analyzing individual companies? Would an ETF give you peace of mind while still growing wealth? Lesson 2: S&P 500 logic, relevant for South African investors. Why the S&P 500 works. Tracks 500 of the largest US companies. Historically, averages 7 to 10% annual returns after inflation. Offers instant exposure to the global economy. For South African investors. Can invest through local brokers offering international ETFs. Reduces risk compared to single stock investing. Takes advantage of long-term compounding globally. Practical tip. Focus on. Own the world, not just a single company. Lesson 3: Monthly investing plans. Key principle. Investing consistently matters more than timing the market. Example, are 5,000 per month invested in a broad ETF. Benefits. Reduces impact of market volatility. Builds long-term wealth automatically. Encourages disciplined saving habits. Student exercise. Decide how much you can invest monthly. Create a simple schedule, first of the month or fixed day. Stick to it for at least 12 months. Lesson 4: What Buffett recommends for most people. Buffett's advice. Low-cost S&P 500 index fund. Ignore market noise. Stay invested for decades. Avoid trading, timing, and speculation. Most people are better off doing less, not more. Reflection exercise. List 3 things you do in your finances that could be simplified. Which habits align with Buffett's advice? Lesson 5: What not to do as a beginner. Common mistakes. 1. Chasing hot stocks or trends. 2. Listening to social media tips or hype. 3. Overtrading. 4. Borrowing to invest. 5. Ignoring fees and costs. Key principle. Simplicity and consistency outperform complexity and emotion. Student exercise. Write down one bad investing habit you will stop immediately. Module summary. Key takeaways. ETFs offer low risk, simple diversification. S&P 500 is a powerful long-term investment vehicle. Monthly contributions build wealth through compounding. Buffett's advice: keep it simple, stay invested. Avoid hype, speculation, and overcomplication. Module assignment. Your simple investing plan exercise. 1. Decide your monthly contribution. 2. Choose your investment vehicle, ETF, index fund, etc. 3. Set a schedule and stick to it. 4. Identify one thing to avoid, e.g., hype, trading, borrowing. Bonus: create a visual chart showing 10 to 20 years of consistent contributions to see the power of compounding. Module completion statement. You now have a simple, actionable plan. Investing is no longer intimidating, it's discipline plus time.